In this week's update is the US market in a bubble, critical minerals update, and gold finally breaks out. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Let's start with a market perspective. What's the position with the US? It's gone up a substantial amount since the lows of late October last year, and it just seems to keep going and going, and the Magnificent Seven keep roaring up. And the natural emotional response to that is, well, it's run too far and it's run too fast. So let's have a look at that, because the market is responding very heavily to either interest rate cuts or perhaps, in an extreme scenario, further interest rate rises. So let's update with what's happening with inflation in the US. In the January personal consumption expenditure, PCE, came in at 0.4, which is a key indicator for the Fed. And that was equal with expectations, but it was the highest in 12 months. So that's just one to watch, and I'm sure it's one that the Fed is watching as well to help them with their timing of future rate rise adjustments. Now, when you unpack that number a little more, services inflation is actually accelerating, which is bad news. Goods deflation, so in other words, the rate at which the average price of goods is going down is starting to slow. In other words, it's leveling off. So we've got one part of the inflation cake is getting bigger faster, and the other part is getting lower slower. So that's not a great dynamic if it continues. And if that were to continue for the next few months, it's hard to see how the Fed can cut rates at all. And the market is pricing in significant rate cuts. 4 at the moment, as far as most commentators go, and the bond market is saying 3. We'll get to that in a minute. So that's one to watch. Now it's just a single data point, so we need to see the follow-up data. But amongst all this, you've really got to forget the logic, because the logical conclusion could be, well, the Fed's not going to cut rates at all. But the bond market is still saying 3 rate cuts in 2024. So that's where things stand. That's what the expectations are, and that's what's priced into the market. If there's anything significantly different from that, then the market is either going to rise or fall significantly, because it's not what's expected. Now, the run in stocks like Nvidia and Amazon and Meta, etc., the Magnificent Seven, continues. But I've got technology bubble in inverted commas, because it's by no means certain that there is one. In fact, my conclusion on the next slide is that technology in the US is not in a bubble, and therefore at risk of coming to a screeching halt and the market crashing. Now, emotionally, it's easy to conclude that the US is running too hard. That's just how we're wired. Naturally, we're going to default to that position when something has just gone up and up and up in a straight line for a long period of time. But it's what the money flows are actually doing that counts, and that's a key part of this video every Sunday, is looking at what the money flows are actually doing. Now, earnings season was pretty good, and the driver around, or the driver for artificial intelligence is real, as I've said in previous weeks. There's no hype about it. There's not even particular overvaluation, really, when you look out to 2025, which the market is just starting to price in now. So there is certainly a very good basis for a lot of technology parts of the US market to continue. And plus, we've now got, finally, after several years of significant divergence, we've now got small caps catching up as well. So it really is a pretty good situation in the US at the moment. So let's just look at this technology. Is technology in a bubble thing a little more deeply? The things that you need are are some of the following. Yes, sentiment is broadly bullish, but it's not overly so compared to some situations. So that's that's a bit of a 50-50. Yes, sentiment is bullish, but there's a lot of reasons why sentiment should be bullish, to be honest. Earnings growth rates appear sustainable, and they appear sustainable because they're highly visible. And this is across a wide variety of industry groups, not just technology. It really spans many parts of the US market. So it's that visibility and sustainability that the market has really picked up on. So that says very clearly that technology is not in a bubble when you've got that very visible earnings growth rate into the future. Then you look at stock prices relative to their earnings per share growth rates and also relative to interest rates, which probably have peaked. And if you look over the long term, they're mostly not that high. I mean, the 10-year yield at just over 4% on a long-term basis is not high at all. And some stock prices are just downright cheap, considering their earnings growth rate. And the recent earnings season has shown that those growth rates are exceedingly high in some circumstances. Another factor that can point to a bubble is that inventories, everybody's just got so far ahead of themselves with the expectation of significant future growth that they've built up their inventories in the supply chains in anticipation of a future bonanza. Well, that's not happening either. In fact, it's almost the reverse. There's still in some areas pressure on the supply chain to meet requirements. So that one is another cross. And the final one I'll point to is the absence of the sort of euphoric activity that you see when you're getting towards the peak in a bubble. And that is, you see an absolute mountain of IPO activity. Everyone's rushing to float, the latest company on some, some spurious whim. Go back, and we saw a lot of that in 1998, 1999, leading into the 2000 crash in the NASDAQ. We saw it pre-2020 and 2021 when there was the evolution of something called the SPACs, the special acquisition vehicles, which were, effectively just cash boxes. All that sort of really exorbitant activity, there's none of that happening at the moment. So when you look at the facts, you can maybe sort of half tick one of the box, but you can't tick any of the other boxes in terms of are we in a bubble? So the inevitable conclusion is that we're not, and therefore what is happening in the US market can continue. Now, we do have a knowledge gap, of course. There's always a knowledge gap. The key one at the moment is just how much and how quickly will artificial intelligence impact corporate earnings? And the answer to that is no one really knows, because it's a brave new world. It's moving very, very quickly. No one knows the answer to that. But intuitively, we know that it's going to be very, very significant. We just don't know how much and how fast. But that will be a key one in sustaining the market. So the end result of all this is that the natural, easy conclusion to reach, just based on our subconscious logic, on our emotional thought patterns, is that it's run too far, too fast, and I've missed it. And a lot of people fall into that trap, because when you look at the stocks that do very well over long periods of time, they just keep going up and up and up, and they run far further than anyone thinks is possible. So I would counsel against getting caught in that mindset that I've missed the boat, it's run too far. And you've only got to look at hundreds of American stocks that just keep rising and rising, and yet their valuation, all that's happening is the share price is just tracking the growth rate in earnings. They're not getting more and more expensive. They are still attractive. So that's the situation in America. The S&P managed to put on a significant 3.6% across the week and gained 5% in February. So it's been a pretty good period, and after a very strong January, the odds were that we would see February and March, the typical sort of slowdown months, give some of that back. Well, not only did that not happen, but it actually accelerated in February. So that really tells you something about how 2024's setting up, and I've been saying that since late last year. We also saw new record highs on the NASDAQ as well. And there are just so many amazing trends. You know, I'm tracking probably north of 150 stocks in the US. There are just so many incredible trends and so many large revenue and earnings beats amongst those stocks. Now, yes, equally, there were stocks that missed and got absolutely punished. But if you've done your homework and you've done your research and you zeroed in on the stocks that have got visible and sustainable earnings into the future, then there is just some staggering trends. And there are so many stocks that are justified to trend in that manner. You know, they're not going up on hype. They're not going up on just sheer momentum. They're going up because it's justified on the fundamental valuation. The US dollar index hasn't really changed much in the last few weeks. It's still sitting just around about 104. The 10-year yield was slightly lower, down to 4.18. And the VIX got up into the 14s, but it's back now down into the 13s. So let's take a look at some charts. This is the S&P on a weekly. So it's gone up. There's only been 2 weeks since the end of October that have been negative, and they've only been negative by a relatively modest amount. And this one was only very slight. So it's been an incredible run now for just over 4 months, going up week after week after week. And you've got to step back from that and look at that chart and say, what is doing that? What is causing the chart to go up like that? And the obvious answer is it's institutions that are trying to readjust their position. And they can't do it overnight. They've just got to keep buying and buying week after week after week to to get on board the train that they should have been on sometime during last year. So that's the S&P. Let's look at some of the key relativities. The NASDAQ versus the S&P is still rising, so the aggressive parts of the market are still being favoured over the defensives. This is one that I've talked about forever. It's a key indicator for me, and just look at how much it accelerated during this period here from May through to January of this year. We had some slight gains on a relative basis between semiconductors and the S&P. It was rising, but it was doing so in a fairly begrudging sort of fashion. But look, it's absolutely just rocketed off again. And a lot of this is down to Nvidia, but there's also been other contributors to this as well. But that's just such an enormously positive indicator of where the money flows are going in the American market. Let's have a look at it on a sector basis. XLC, XLK, the two key aggressive sectors of the market are leading the way over the last quarter. XLF has done really quite well. So there's been a good recovery in the banking system in America, or at least in the majors. XLV, so healthcare, is also starting to work its way back towards the top again. Consumer discretionary also influenced, of course, there by Amazon. But we've got materials also improving quite significantly. So that's the last quarter. Let's just zero in on the last month. And we can see that the consumer discretionary has done the best. Materials have done very well. And of course, technology and communication services. So this is all positive money flows in America, and all of this tells me that 2024, there is absolutely no reason why 2024 can't continue in the fashion that it's started. Now, we're not going to get 12 consecutive months of gains. That's just completely unrealistic. So there will be a period of consolidation, of pullback, but from where things look at the moment, the end of the year looks to be higher than where we stand at the moment, and possibly significantly higher. Now, if we go to the Australian market over the last quarter, and this is the information technology sector, and it's absolutely rocketed off in the last month or so, and that's largely down to Xero and Life360 and WiseTech Global have contributed very significantly to that. And Life360 in the last week, I think it went up something like 35% during last week. So there's been a very significant move there. If we come down into the last month, or actually let's look at the last fortnight, you can see just the incredible move in that part of the market. So finance has done well, small caps have done well, and of course information technology, they're the leaders in the Australian market, but it's very pleasing to see the small caps starting to pick up now. They've been lagging, whether it's America or Australia or wherever you look. Small cap stocks have been shunned for 3 or 4 years now, and their relative valuation is just about at an all-time low compared to large cap stocks. So eventually everything reverts to the mean, and we're starting to see some catch up in small caps now. So that is the American market. Let's look at Australia. Our dollar still pretty much doing what the Aussie dollar's doing, and just sitting there around 64, 65. Our market gained 0.6% across the week, and as I indicated there, it was infotech and finance were the big winners. But look, small caps have shown some amazing gains year to date, and the portfolios within the Insiders Club have done exceptionally well. So that's been very, very pleasing. If we go and have a look now at the Aussie indices, so we've broken out here on the ASX 200 quite clearly. This is a weekly chart, so that was a pretty decent week. But if we look at finance certainly has had a very good run over the last few weeks. Healthcare, bit of a pullback, great run here, but bit of a pullback in healthcare. But it's really been the IT sector that's done exceptionally well. All right, let's move on now to precious metals, because this is a pretty good story as well. Gold up $48 to 2083, and it's the highest ever closing price, not the highest intraday price, because we had that spike last year, that one day spike or 12-hour spike, but certainly it's the highest ever closing price. And I've been talking about this now for a few months, that gold has been coiling under that resistance level, and it would now appear that it's managed to break out. If we translate that to Australian dollars, it's $31.92, so almost $3,200 Aussie. And I'll get to something which is really interesting in a minute, and that's that stocks are just not reflecting this move in the underlying metal. So let's jump in and take a look at that. We'll look first of all at GDXJ. So this is basically the global index of gold stocks, and you can see quite a nice move on Friday night. But there's no trend; it's just flat sideways. And when you consider that gold has been going up, this is pretty drab. And if we go back to, let's look at GDX in Australia, so this is really reflecting just the Australian gold stocks. That really is very, very sad. We had a bit of a gap up on Friday, but no real volume behind it at all. So that's a very poor situation with the 200-day. All the moving averages are still pointing down, and the price is below all of them. So you've got to say that this is still in downtrend. And if we put that on a relative basis, so this is GDX against the Australian dollar gold price, not the US, but the Australian dollar gold price. And you can see, this is over the last 5 years, you can see that, by and large, there's a few exception periods, but by and large, they should track together. If the gold price is going up in Australian dollars, then the value of Australian gold stocks should go up. And that was largely the case until we got to about May last year. And then there's been this incredible divergence where the Australian dollar gold price has risen, and all that's happened is the value of Australian gold stocks has fallen. And now we've got this huge divergence, not only in direction, but in value between what the gold stocks are currently trading at and what the Australian dollar gold price is. Now, that doesn't mean that it's got to turn around instantly. But at some point, we're going to see some mean reversion, and there is certainly a very strong case for this gap to close, and close very significantly. Now, if we look at, so that begs the obvious question then, what is the value of the Australian gold stocks? Are they now looking really of extreme value? And just using Northern Star as an example, and no particular reason other than it's just one of our major gold stocks. So if we look at the earnings profile from 2020 to the forecast for 24 and 25, you can see we had a big dip into 2022 and then an even bigger dip into FY23, but then a big surge. So the earnings are expected to surge significantly into 24 and then again into 25. Now, that had pushed the PE ratio up. This drop in earnings had pushed the PE ratio up way beyond where it normally is. So that underperformance by gold stocks was fair enough. And I guess that's because of increasing costs in particular. But look at where we sit now. If this earnings is achieved for FY24, then that drops that PE to 24, which is probably about fair value. But if FY25 is achieved, then we're now getting down to levels, particularly with the gold price breaking out, that are really at the bottom end of the range. So from a fundamental valuation point, it's building. It doesn't have to reverse now, but it's building. So I think at some point you are going to see Australian gold producers start to play some significant catch up. And they'll be the first ones to respond. It will then filter down the line to other areas of gold development stocks. But I'd say where we sit at the moment, the risks are more to the upside for gold stocks than they are to the downside. So I think that's pretty clear from this chart. Oh, sorry, I forgot one thing. Let's just go back and have a look at the gold price, of course, in US dollars. So there's the breakout. This is on a daily chart. This was the all-time high that was achieved back in December with that roughly 12-hour spike in price that collapsed. But the gold price didn't really fall apart. It just spent a bit more time, another couple of months consolidating. But now we've got this very good breakout. And if you look at it on a weekly chart, it's even more obvious. So we're sitting about the middle of the channel. There's plenty of room now that gold's broken out for this to accelerate to the upside. And that was a pretty big move on Friday. So it may well be, if it's like normal, that we'll now start to get all the people that have been sitting on the fence, wondering whether gold was going to break out or not, are now going to start to join into that momentum. So that's gold. Something has to give in gold. Either the gold price has got to fall, and that last chart does not suggest that at all. In fact, it suggests very strongly quite the opposite. And so therefore, gold stocks have got to play some significant catch-up. Turning to other commodities, copper, pretty much level, 386. Nickel, however, did improve from the low sevens to the high sevens. So is that a recovery? Oh, look, I don't know. I guess where I'm sitting with nickel is that Indonesia has distorted the market in such a way that it's hard to feel confident about where the nickel price is going or where the price of nickel stocks are going. And so I just don't play. If I don't feel confident about how things are unfolding, then I just go and work in another area. So I'm just dismissing nickel stocks at the moment, and all talk of, this might happen or that might happen. BHP may or may not close their WA operations, or someone might do this or that. It's all conjecture, and you can't be investing on conjecture. So I'd rather just leave the sector alone and go where I have far greater levels of confidence. Crude oil was also higher to almost 80, and we'll look at that chart in just a minute. Other commodities, let's look at lithium. The lithium carbonate futures are on the rise. Some of the fundamentals have shifted. We're seeing mines being shut down in China or restricted in China on environmental grounds. So there's been a definite improvement. Now, whether it's sustainable or not, again, who knows at this stage. But stocks have started rebounding. Now, the big question is this just a temporary short squeeze where everyone has temporarily gone to the shorters have gone to the buy side just to readjust their position? Or is it a sustainable reversal? And the answer is, at this stage, no one knows, because short sellers are a pretty unpredictable band of people. So it's impossible to know. But certainly there is enough evidence that we could have seen the bottom in lithium, and we could have seen the bottom in rare earths and graphite as well. Just on uranium, uranium was trading around 106. We've now down to the mid-90s. So that's been a bit of a big step change there in uranium. And that's caused a bit of a consolidation in the uranium stocks as well. There's the spot nickel price. You can see quite a sharp recovery in the last couple of weeks. And there's the crude oil chart shooting back up to 80. So wrapping things up, trying to pick the top in stocks or in indices in a bull market is really a pretty dumb thing to try and do, because the overwhelming likelihood is it's going to get you out way too early and you're going to leave a lot of money on the table. So the approach that I've been advocating for a long time is just find the most justifiable stocks, the stocks that are justified to go up and keep rising for years to come. And there are plenty of them. There are more than enough for anyone's portfolio. So just go and work with those. These thoughts of diversifying your portfolio across all sectors to manage risk is just complete rubbish. Find the most justifiable stocks and have a clear plan for their purpose. Are you owning them for the long term, 3 to 5 years? Are you owning them for the shorter term? Are you trading them? Are you using stop losses? Just a few simple rules around the purpose, and don't chop and change the purpose according to what the price does. We're seeing lots of strange price movements at the moment over the short term, where the actual business is going ahead great guns and will almost certainly continue to go ahead for the future. So why worry about short-term price movements? And then manage risk well. Let the market, not your emotions, show you where the significant reversal points are, because the good stocks will run further than you could possibly think possible. So just let them go until the market tells you that it's the time to do so. Portfolio analyst last week was a week of rest and recuperation for yours truly. But next week we got Taking Stock. We'll highlight numerous excellent gainers which have been highlighted in Portfolio Analyst over the last month. But where the real action is I've got to say, is in the Insiders Club. The portfolios there are doing exceptionally well, and we would encourage you, if you haven't looked at Portfolio Analyst Trial, then take that trial for a couple of weeks for $1, and I think you'll get a lot of very valuable insight and information. That's it for this week. I'll be back with you next Sunday. Cheers.